Hello everybody, this is FX. Once again, you are welcome to my YouTube channel. If you are new to the channel, kindly subscribe, turn on the notification button so as to get informed each time I drop a new video. So today we'll be talking about ICT mastery, that is the inner circle trader. So this is the only 6 things you need to know in order to become a successful trader. First thing on our list is you need time, you need liquidity, you need to understand the concept of fair value gaps, which is the imbalance. Then you need to understand market structures. Market structures, very, very necessary. You also need to understand the rules of an order block. Then you need to understand the premium versus the discount areas, which is the PDRAs. So when we talk about time, the key zones for time. So time of the day, normally it matters more than most people think. So in ICT trading, time matters most because the market moves at certain times of the day. That is to tell you that time and price works together. There are some certain price, sometimes on the market whereby market always repeats itself. So specific things happens at a specific time on the market. So big traders called smart money, which are the large traders, the big boys, they also trade at specific times, like the New York Open or London Open. So these times brings lots of actions, and that's when the best trades usually happen. So because of the high volume of market participators, it brings about high volume that specific time. So it's very good for you to look for trades at that particular time. Remember, you want to trade when market moves either in a bullish direction or in a bearish direction. You don't want to trade on a choppy market. You don't want to trade on an indecisive market. We like to follow the trend. The New York Open and London Open is the best time to trade. The best time. So knowing the right time to trade helps traders to catch the right moves. So in ICT trading, being in the right time makes all the difference. That is why you need to focus on time and price. Time and price, very, very necessary. Now, when we talk about the ICT key zones, key zones are high probability trading windows based on institutional trading behaviors. Below are the primary key zones that ICT uses. The Asian kill zone, you can see, the London kill zone, the New York key zone, the London close key zone. These are the Eastern times. You can see. So you can work with that. And the New York midnight, which is the 00 hour, opening price is playing a major role in anticipating the daily direction. So 8:30 opening price is playing a major role in anticipating the New York session movement. So that's it for the key zone. Now, when we talk about liquidity is another major thing to take note if you want to be a successful trader. So liquidity in ICT trading refers to areas on the chart where there are a lot of pending buy or sell orders, usually above swing highs and below swing lows. Or that can be in the form of equal lows or equal highs, basically support and resistance. So I made an example here. So I actually made this PDF. So these are areas like magnets, because smart money or big institution needs large orders to enter or exit the market. So the market moves to these zones to grab that liquidity, triggering stop losses or breakout trades enter. You understand? So once the liquidity is taken, the market often oversees or makes a strong move. ICT traders look for these liquidity pools and anticipate where price is likely to go next and when it wants to reverse. This is what they are trying to say. This was a high. You can see this buy side liquidity. This was a high. a double touch, then liquidity got taken out, whereby people stop losses, people sell, people the early, let's say the early sellers, people that sold from this point, they will be placing their stop loss at this area. Now liquidity happened, taking them out before moving to the right direction. So once you see a first touch, you can easily mark out the high, wait for a liquidity sweep before entering the trade. That is the manipulation aspect. Remember, we work with the power of AMD: accumulation, manipulation, and distribution. This was the accumulation, the first swing high here. This one didn't take out the high, which means it's still under the accumulation. After this liquidity sweep, the manipulation happened. Then distribution was the what? Was the opposing trend. That's it. This is for the what? The bearish buyers. Now look for the bullish buyers. We have a low here. A liquidity sweep happened, taking out this low. Then people stop losses, got haunted, and the trade started pushing up. Remember, this was the accumulation phase, giving us this low. Manipulation happened, taking out people's stop losses, the early buyers. Then what happened? Market continued to the right path. That is what accumulation, manipulation, and distribution. It's very simple. So moving to the fair value gaps. Fair value gap is a gap between candles that shows an imbalance in price. You understand? So it usually happens when price moves quickly in one direction, skipping over levels where buyers and sellers didn't get a chance to trade. So this creates an what? Inefficiency or space on the chart. It's self-explanatory. Price often returns to the gap later to fill it because the market likes to be what? Balanced. Traders use fair value gaps as potential entry points. Remember, it's an entry model, expecting price to react from them. Imbalance is internal range liquidity. So most of the time, price always comes back to fill it. So traders use these fair value gaps areas as potential entry points, expecting price to react from them. So they help identify where smart money may have entered and where price might return before continuing its move. So it's a gap between first candle and the third candle. Remember, you need three candles to form a fair value gap. Most of the time, it should be a three-dimensional order flow. So there are rules guiding fair value gap. I will release a video explaining more about these 6 things you need to know before gaining profitability. So make sure to turn on the notification button. I'll be releasing a video next tomorrow where I'll be starting from the first order there. So I'll be explaining the rules you need and how to understand perfectly what it means. So this is a fair value gap. Remember, there are so many rules guiding fair value gaps. I'm just giving you an insight. So this is an example of a fair value gap, whereby the 2 weeks are not touching, giving you a space in between the third candle, the middle candle. That is a fair value gap. So most of the time, if something like this happens, expect price to always what? React. Expect price to react like this. Probably react to it before pushing to the upside. This is a bearish fair value gap. Same example. A bullish fair value gap will support price to go higher. You understand? Why a bearish fair value gap will resist price to go what? Lower. So if we have a bearish fair value gap, you will see that price will likely trace up before what? Pushing down. Remember, it's a what? Internal range liquidity. Liquidity has to be taken out. You understand? So that's it. That's it. Now, when we talk about the market structure, the market structure shows the direction of the what? Market. So it shows the direction the market is moving, either up or down, which is the bullish or bearish ways, or sideways, which is the consolidation, or maybe choppy and indecisive. So when price makes higher highs and higher lows, it's bullish. You understand? That's the simple definition of a bullish structure. So that's the example of a bullish structure. If it creates a series of what? Higher highs, higher lows, meaning that what? The buyers are in control. So when it makes lower lows and lower highs, lower lows, lower highs, that indicates a what? A bearish trend. So it's actually showing the trend that was sellers are in control. You understand? So a break in market structure happens when price no longer follows this pattern and shifts direction. Are you getting the point? When price no longer follows this pattern and shifts what? Direction. Either if it shifts from what? the bullish to the bearish or bearish to bullish. That market structure is what is happening already. That's where you get market structure shift. You understand, from a bullish bias to a bearish bias. So traders use these shifts to point when smart money is changing the trend. Change. You understand? So understanding market structure helps you to what? Follow the flows of the market and also trade with what? The big players, which are the smart money. So in this case, we have series of what? Lower lows. You understand? Lower lows. Look at the breakup structure. These are the lower lows, lower lows, lower lows. You understand? This is a bearish trend. Why this? We have a higher high, which is the what? The bullish structure. That's that for market structure. Just get that for the meantime. Like I said, I'll be releasing a video explaining each of the topic in full. I will be explaining each of the topics in full. So do where to turn on the notification button so you won't miss out. And remember to subscribe. So other blocks. And other block is the what? Is the last bullish or bearish candle before a strong move in the opposite direction. So it shows where smart money plays big orders to start powerful price movement. So these zones act like what? Footprints of big players and are often used at support or resistance areas. So when price returns to another block, it may react there, either bouncing in a bullish structure or reversing in a bearish structure. So it's very, very simple. It's self-explanatory. Other blocks are what? Are same are what? They are still internal range liquidity. So there are areas of reversals. You understand? There are areas of reversals. These is another block, though it's not clear here. This other block is not clear. It's not clear in this diagram. So I think we have a clearer one here, which is this diagram. So you have a bearish order block whereby price reacted to it before what? Pushing to the downside. So same thing, just use same ideology here, though it's not clear. I will be releasing a video about order blocks especially, so I'll just do it to subscribe. Now you see what I'm telling you about. The other block is on what? Is the reversal point. That is where price reversed from. That is where price reversed from. So you need to understand what an order block is. When we talk about premium and discount area, we're talking about the PDRAs. You understand? So when premium and discount refer to where price is within a range. So it's where price is within a range, usually between swing highs and swing lows. So the premium zone is the top half of the range. Just measure it by 50%. That is it. 50% average above is the premium area. 50% below is the discount area. That is for a what completed what trend. Let's say we have a bullish market. Let's say we have a bullish market here. Look at this is a bearish market from here to this place. When we're talking about completed trend, for example, I want to talk about the protected highs and low. When we talk about protected highs and low, we are talking about the previous trend. The previous trend. So this was a high, this was a low. Before what? BOS. This was a high, this was a low. Remember the major high and low before break of structure to create another what? Here will be another high, then wherever market reversal turns to be the low. So once you mark out the previous high and low, the midpoint above, from the midpoint to the upside is the premium area, to the downside is the discount area. Look at what I mean. This was the major move, this was the high before the retracement, then another high again. Remember, this very high like this is where we mark as the completed swing. This is a completed swing before another what? Swing operation here. Now, once you divide the swing by 50%, 50% above is premium, 50% below is discount. That is PDRAs for you. Identify the market structure in higher time frame, probably 4 hour or 1 hour. Then draw the Fibonacci retracement from high to low or low to high, whatever way you want it. Then only look for buys in discounts. Remember, you have to buy at a discount level where price is lower. That's where you look for buys. That's the major concept. Then you have to look for for sales at a premium area. You have to sell your product when the price is what? When the price is what? Has skyrocketed. So only look for buys in discount, which is in a bullish structure. Then look for the sales in premium, which is in a bearish structure. That's the simple terminology there. Now, how to combine all six? Identify the higher time frame. This is the key role, how you combine all six of those topics. So identify the higher time frame market structure on the 4 hour or 1 hour chart. Wait for a key zone time, probably London or New York. Once you identify the structure, draw the fib retracement. If bullish, low to high. If bearish, high to low. If the market is bullish, make sure you do the low to the high. If it's bearish, do the high to the low. That way you get your 50% average move, either from 0 to 1 or 1 to 0, depend on the market trend. Now, only look for buyers in discount and sales in premium, like I've already said. So, for example, if your higher time frame is bullish, then draw the fib from the low to high and mark your key level, fair value gap or other block, etc. So, once price reach your higher time frame level, simply look for a liquidity sweep inside that key level. You understand? So, then look for a shift in price in lower time frame. It can be lower time frame market structure shift, inverse fair value gap, change in state of delivery, which is the CISD. So that's your entry. Target opposing liquidity at true risk reward. It's just a simple concept. So I'll be dropping a video next tomorrow explaining each of the topics. So I'll be explaining all you need to know about time, which is consists of the CRT concept. So that's it. On our next video, we'll talk about liquidity, then fair value gap, market structure, order block, premium versus discount. I'll be releasing tons of other videos, so do well to turn on the notification button, like and subscribe. Bye for now.